Welcome to this Killick Explains video, and welcome to the third and final part of my Back to Investing School series. Part 1 was all about profit, Part 2 is all about assets, and Part 3, this one, is all about cash flow. And I want to set the scene by basically bringing together all three videos with a kind of old cliche that one or two of you may have heard before, and it's this: revenue is vanity, profit is sanity, but cash is king. All right. In other words, what that is saying is that sales numbers are fine, but can you fully trust them? Profit is a bit more believable because that's sales minus costs, but cash ultimately is what's going to pay your dividend and is what the company's going to use to reinvest. So cash is the real deal. So the first point I want to make here is, what is cash then? What is cash flow? Why isn't profit the same as cash? All right, well, basically an accountant would say in a slightly nasal tone, it's because of the accruals concept. What does that mean in real life? What it means is that profit numbers are a function of revenue earned and costs incurred. Cash or cash flow is all about pure cash in, pure cash out. And if you're wondering what the difference is, you're not quite sure, let's take a quick numbers example. Imagine you've got a small business, all right, and it's basically running off over a given period 100 million pounds of sales. Sounds good. And 80 million pounds of costs. Because there are costs of making sales. What would the profit situation be? Oh, no prizes. 100 million minus 80 million is 20. And let's also say that all of that activity is cash-based. So in other words, customers pay for the stuff they're buying, and we have to pay our suppliers straight away. In which case, your net cash flow is also 20 million. £100 of cash sales, 80 million of cash costs, profit 20 million. So profit and cash are the same, so what's your point? Well, now let's make it more realistic by introducing credit terms, which most businesses have to operate off. Most customers don't pay you straight away. Most suppliers will wait a bit. So let's say you're a small business, so 3/4 of those sales had to be on credit to get people to do business with you. And meanwhile, only 1/4 of your purchases were on credit, because you're growing the business in order to encourage suppliers to supply. Not all of them will agree to any other terms. Now, where are you? Well, you've still made 100 million pounds of sales, still incurred 80 million pounds of costs. So the profit view of the world would say, no, your profit is still, for that period, 20 million. But someone focused on cash would say, hang on a minute, got a different picture here, because actually, realistically, only 25 million of those sales came in as cash. 3/4 were on credit. Whereas a huge chunk of those purchases had to be paid for, 3/4 of them. So actually, your cash flow isn't 20 million, it's minus 35. So you have made a profit of 20, but you've actually burned through cash of 35 million. All right. Now, you may say, and that might change the next period when we collect our debts and so on and so forth, but you get the idea. Profit and cash are not the same thing once you draw a snapshot of, say, a month or a 12-month period. Why does this matter? Well, it matters for several reasons. If you are focused on dividends as an investor, you need a company to be able to generate consistent cash flow. Because you can't pay dividends, physically pay them out of profit, you pay them out of cash, all right? There are also operational efficiency implications here. If a business can't regularly turn profit into cash flow, it could even go bust, all right? So keep an eye on liquidity and solvency. To what extent is the business matching short and long-term assets and liabilities? Or to what extent is it able to weather negative cash flow? And those are quite important aspects where you see a big difference between profits and cash flow. All right. So what I'm going to say is keep an eye on what is called technically cash conversion, the ability to turn profit into cash flow, asset and liability matching. That is, are we using long-term debt to fund long-term assets, short-term for short-term, all right? And consistency. I'm not a big fan of huge volatility in either profits or cash flow, particularly if there's no obvious explanation for it. Finally, some businesses burn cash. The one I just mentioned did 35 million in just a month, let's say. Watch out for those. They will argue we need to grow, we need to get people on side. It's growth at any price. Yes, in the early years, we're going to be burning cash. Be careful. all right, because they've got to get their funding from somewhere, and in an environment where interest rates are a little bit higher than they used to be and may stay that way, who knows, those companies can come under increasing pressure if they can't solve those rates of cash burn. Now, lots of jargon in there. That's the end of the 3-video series. If you're thinking, crikey, quite like to find out a bit more about some of that stuff, go to killick.com/resources for other related videos. You could pick up or tap the same place in the website for a copy of my How to Invest in Equities guide, available also at houses, branches, and so on. And then there's the quarterly magazine, Confidant, which is full of commentary around some of the terms I've just mentioned in relation to stock market investing.